Hello and welcome to Money Markets and More with me, Dominic Frisby, coming to you today from California, where I'm visiting my mother. I've just been in New Orleans at the investment conference there. That was great, and I got to speak on a panel with Konstantin Kisin and Matt Taibbi. That's the sort of company I should be keeping. And it's been a long time since I've done one of these. My apologies, but talking to Konstantin's got me motivated to do some more of these. Today's piece is called Why You Should Buy Stocks Now. And before I start, let me just plug a show I'm doing in January. My gold lecture's coming back to the Museum of Comedy in London. It went down really well last time, sold out, and the venue have asked me to come back and do another couple. And this is a really good show, even though I say so myself. So please come, and I'll post a link in the comments. Right, stock market. It's about to go up even more. Here's why. The tricky month of October, the month of choice for the stock market crash, is now behind us. There was a wobble, very wobbly wobble, but the blob held, and the stage is now set for a juicy rally into year end. November to January is historically the best 3-month period of the year for the S&P 500, which is the index of the largest 500 companies in America. And November to April is the best 6-month period. And we're at the beginning of that run, a little way into it. If you bought the Dow, or the S&P, but we use the Dow here, on November the 1st every year and sold it 6 months later on April 30th from 1950, a 10 grand stake would now be 1.2 million. But if you bought the Dow on May the 1st every year since 1950 and sold it on October the 1st, you'd barely be at break even. And that's some difference, particularly when you add in currency depreciation into the mix. One option gives you break even over 73 years, less inflation. The other option gives you 1.2 million. Don't ask me to explain why this is. It might be some kind of self-perpetuating herd mentality thing. It might just be that different people do different things at different times of the year. I swim more in summer, for example. I know that sounds trite, but you take my point. But there's more. This is the third year of the 4-year US presidential cycle. And it might be because the powers that be are trying to get everything looking hunky-dory in time for the next election. It might just be one of those things. But third years are very good years for stocks. They're the years in which the strongest gains come. And that's one of the reasons I was arguing back in January that this would be a good year for stocks. And I was also making the argument when we had that big wobble in March. This year's been particularly good for stocks, especially the Nasdaq. I think it had one of its best first 6 months ever. In 2019, in Donald Trump's third year, there was a 27% rally in the S&P. And prior to that, from 1933 to 2015, the average gains have been 16% compared to 6% for the other 3 years. And so that November to April run is even stronger in the third year of the US presidential cycle. The plane's going overhead. So we're at the most bullish time of the year in the most bullish year. It may not feel that way after the October we've just had, but October's almost always the most volatile month. They're often so horrible that nobody wants to buy, which is in itself almost reason to buy. Buy when you don't want to, sell when you don't want to. It's a pretty good stock market adage. Sentiment models are looking good. There was a retail sentiment survey a couple of weeks ago, and it showed 50% bears. Hedge fund sentiment is similarly contrarian bullish. Long short funds are the most defensively positioned in 11 years, apparently. Insider purchases are up, and they exceed insider sales. Bond markets have calmed down. Inflation, as they measure it, is calming down in the US too. And there was also a Zweig breadth thrust buy signal. I'm not going to try and explain what that is. It's a technical symbol. Google is your friend. Just know that it's bullish. We had a lot of talk about an impending stock market crash last month. It didn't happen. If it was going to happen, I think it would already have happened. And then the last week or so, we've seen an eye-watering reversal short covering rally. So we can expect a bit of digestion, I'd say, over the next few days, a couple of weeks maybe, before things get going again. But how to play all of this? Be long equities, be long the S&P 500. ETFs are the way to go if you want to track the S&P 500. But thanks very much for watching. Please subscribe to the channel. I'll be back with another video, hopefully very soon. Goodbye, and please don't forget to come and see my show in February in London. It's really good and you'll like it. And I'll put a link to my Substack as well, and there are some ticker symbols on there whereby you can find some vehicles by which to play this. But in the meantime, have a lovely day, and I'll be back in London very soon.